What's going on, ladies and gentlemen? Welcome back to the channel. Welcome back to a crazy day on Wall Street. We have a lot to talk about. The dollar is down today. We had some comments from Fed Daily that definitely helped us out, and we are now not pricing in that 1% rate hike really at all anymore. So we got a lot to talk about in a very short amount of time. Let's get straight into it. Hit the like button and subscribe to the channel because it is free 99. Thank you guys for doing that, and let's get straight into this video. So first and foremost, what is happening for the day? It's pretty straightforward, and I think the biggest thing was retail sales. Retail sales rose more than expected in June as consumers remain resilient despite inflation. Key points. Retail sales rose 1% in June, slightly better than the 0.9% estimate. The numbers are not adjusted for inflation, which rose 1.3% on a monthly basis, indicating that real sales still were slightly negative. Gasoline stations, online sales, and bars and restaurants were some of the biggest contributors. So obviously, good thing, retail sales being positive. It's not necessarily a bad thing. The only thing that it could have been a bad thing for was the probability of a 1% rate hike. But the Fed is doing this dance right now where they're trying to talk down a 1% rate hike. It seems like the Fed themselves don't want to do a 1% rate hike. And what I mean by that is you have Fed Bullard that came out and says it doesn't make too much difference to do a 100 basis point or 75 basis point at the next Fed meeting. And this was the guy saying we're behind the curve, we need to raise, we have to get up to neutral or restrictive exponentially. He was the first guy to basically say, yeah, we are wrong and we need to do our job. So it's very interesting he's coming out and saying this, and the markets are paying attention to what he is saying because, if Bullard's not going to go for it, probably not going to happen, right? And you also, on top of that, you got the University of Michigan, the basically survey, consumer survey. They go over a lot of different things. Expectations for inflation. They go over pretty much, do you expect to be in a better situation a year from now? A lot of different factors. But the main thing the markets wanted to see was what is the consumer expectations for inflation. And the University of Michigan 5-year inflation expectations are now at their lowest point in a year. People expect inflation next year to be around 5.2%. So when you expect lower inflation over the next year, well, that's typically what you tend to get. Businesses, if they expected inflation during 2020, they just started raising prices, right? 2021, 2022, and we got that inflation, and consumers were more apt to just pay it. At a certain point, when people raise their prices or businesses raise their prices too much, people will stop buying those products or services as long as the consumer did not expect it, right? So I think that's pretty straightforward, and the markets definitely did like that. And then you also had Fed Daily that came out today and said the U.S. economy is strong. She says, we are beginning to see inflation coming down. I don't have recession high on a list of possible outcomes. So they really tried to talk down the odds of a recession, but also this 1% rate hike. Fed Bullard says, I take yield curve inversion seriously as a signal, and as of right now, the yield curve is still inverted 20 basis points. So people still expect a Fed error. They still expect higher interest rates over the next 2 years, but they expect lower interest rates over the 10-year period. That is why investors are currently buying or selling the 2-year bonds and buying the 10-year bonds. Also, another big reason why the stock market is actually up so much today is because the dollar is down so much. The dollar is down over 0.5%. And if you guys are unaware of this, the dollar has been rallying very, very hard. So what this does, because let me just explain it. You would think the dollar strengthening would be a good thing, but it's actually not. The dollar strengthening means that global currencies are weakening. So one, it's a sign of a recession and people are getting fearful and flooding into the US dollar and selling other currencies, but it also hurts economic activity because in Apple, Microsoft, or basically any other company that does business overseas that has to convert the foreign currency into dollars, well, it takes more foreign currency to equal $1. So that conversion rate is not so good. So a company like Apple doing 20-30% of their business in China, or Tesla, that's not good for the conversion ratio, and it actually hurts company earnings. So having somewhat a weaker dollar is actually better for economic activity. Like you can see back here during 2021, when the US dollar hit a pretty much multi-year low at 24.09, well, economic activity was booming because partly that conversion rate is good. But this is like the VIX on steroids. If you want to know how fearful people are in the world, you want to look at the US dollar. This is the COVID crash. So whenever there's a lot of fear, look at the dollar. It spikes up like crazy, went right back down because people realized it wasn't as bad as we thought. But look at the parabolic rally that we have been on as of recently. It has really been affecting the stock market, and it will affect company earnings. Give it a little bit of time. Now also, we do have a new estimate from the Atlanta Fed GDP Now tracker that shows that the GDP is likely to fall. Once we get that Q2 advanced estimate for GDP coming July 28th, we're expecting now a negative 1.5% decline. That would mean we are in a technical recession. Now, this is probably a good thing for the stock market because a recession means massive deflation. It means the Fed won't have to raise rates as aggressively. Quite possibly this rate hike, the 27th of July, if we get a 75 basis point rate hike and we are now in the 2% range, you'll probably start to see somewhat of a U-turn from the Fed. You'll probably start to see smaller rate hikes. We might go back to a 0.25% rate hike until we can get up to whatever we need to get up to, 3% possibly. And that could be a very good thing, as the Fed would probably be able to pivot. Price of oil would fall probably to $60 a barrel. You'd probably see inflation fall off a cliff. That could mark the end to a bottom. The question then is, how deep is a recession going to be, and how bad will company earnings actually be affected? So you have all of that. Like I said, July 28th, you get the advanced estimates for Q2 GDP data, and then coming on July 27th, we are expecting with about a 68.5% probability of a 75 basis point rate hike. Like I said, 31.5% chance of a 1% rate hike. As long as this is not over 50 or over 60%, we're not going to get a 1% rate hike. The markets have to be expecting it. They have to be pricing it in. And as of right now, we are not. And I don't think Fed speakers are all of a sudden going to start expecting a 1% rate hike after they have really been talking it down over the last 2 days or so. So we had retail sales today. We had Fed Bostic, which pretty much reiterated the same thing. Really doesn't want to do a 1% rate hike. Thinks the economy is in a pretty good shape. Michigan consumer sentiment preliminary for July. That is what really moved the markets as of today. Now let's go out to next week and let's take a look at what potentially we could be setting up for ourselves on Monday. Nothing too crazy. A couple bond auctions, but really no economic data that's going to move the markets. On Tuesday, housing starts for June, building permits for June. That's it. For Wednesday, you have Canada's inflation rate. Canada just raised rates by 1%. Just so you guys know, that's what helped our 1% probability or 1% rate hike odds go up over the last 2 days. On Wednesday, existing home sales. That's pretty much it. Thursday, you do have jobless claims, initial jobless claims, Philadelphia Fed Manufacturing Index, some bond auctions, but that's pretty much it. On Friday, you do have S&P Global Manufacturing, Canada retail sales, but really nothing else. So I think what's really going to dominate the markets is going to be earnings over this next week, and we don't have really big earnings at all, so it could be kind of bullish. Seasonally, the stock market is pretty bullish in July. Really, July to October tends to be the best time period for the stock market, as you do tend to see lower volumes sell in May and go away in full effect. Currently, people are out on vacations doing things. Can't imagine you're on a very long vacation if you have a stock portfolio because things are moving around so much, but you guys get the idea. We could see a seasonally bullish move next week. Now let's shift gears and talk about AMC stock. AMC closed the trading day up about 2%. You are seeing the short interest at 17.95%. Yes, that is only an estimate. We know the short interest is actually much higher than that, and today was an overall bullish day. Free flow out on loan 25.34%, shares out on loan 130.61 million, days to cover at 3.2, cost to borrow at 11.6%, 100% share utilization. Cost to borrow max sitting at 15.16%, cost to borrow average of 10.8%, cost to borrow minimum of 8.93%. As far as the option activity is concerned, you've seen 16 orders totaling $1.04 million, positive order value of 68%, and just looking at the option activity, it looks overwhelmingly bullish, and that's partly why we have seen this rally over the last 7 trading days or so. And if you even see the move into close, I mean, we pretty much ripped the last 10 minutes of the trading day. So did the broad markets, but AMC ripped just a little bit more. If we pull this out to the daily candlestick chart, you can see that we are fighting to break out above the 100-day moving average. What you want to watch right here is, can we break out of the 100-day moving average? If we do, that will turn into support. But right now, you want to see if we can hold above $15 per share. It looks like we're in a very close range playing this tug-of-war game, but I do think we're going to break out to the positive side, even considering on August 4th, we have earnings and win pounce should come into play. We should get some very good announcements. So at the very least, I don't expect to make a big move down in that time. Could be a decent time to sell some weekly covered calls if you guys did want to collect some premium. Hey, if people are buying options, you guys might as well be the ones to sell them instead of the market makers and collect the premium. That's the way that I look at it. Now, if you look at the MACD is still very bullish, but not that bullish. And if you look at the RSI, it is at 60.56, so approaching that level of 70, but not nearly on the overbought side as of yet. Now, for next week, you do have a smaller expiration for July 22nd, 17,000 calls that are currently in the money, 56,000 calls that are currently out of the money, and about 4,200 call puts that are currently in the money as well. But as you guys do know, really what affects a stock as far as a gamma squeeze, as far as option activity, is really how aggressive do people want to get into close to the money options, and when are the market makers actually going to have to start hedging. And even, I want to call this out, the fact that we only seen about 26 million shares trade hands today and the price of AMC went up 2% is also a very bullish thing. Once we get higher volume that comes in, we can expect to see higher moves. So that is pretty much going to be all for this video. That is what you guys need to know. Thank you guys for tuning in. Hit that like button and subscribe to the channel if you guys have not already. You guys enjoy the rest of your weekends, and I will see you in the next one.